Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in 45 minutes or less. We break down the world of investing from beginning to dividends so that you can hopefully make some returns. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
I'm very good, Bryce. Very excited for this episode. I don't want to play favourites, but one of our favourite experts back on the show, the very first expert to come on Equity Mates, actually, all the way back in 2017.
Yeah. Hopefully not the last.
No.
No, it is our great pleasure to welcome back Andrew Brown to the show. Andrew, welcome.
Thanks, Bryce. Good afternoon, Alec.
Good afternoon.
For those who have just joined the show and haven't listened to any of Andrew's episodes, firstly, welcome to the journey of investing and Equity Mates. Secondly, we suggest you seek out the interviews with Andrew because they are incredibly full of insight. And thirdly, Andrew is a highly experienced investor with a history of 35 odd years investing in the markets, has worked in Australia, London, New York, so pretty experienced, and we're happy to bring him back to unpack sort of what has been going on since we last spoke to you, Andrew. When was that? Mid-crisis?
Yeah, it was. We spoke just before the crisis, really, and then we had a quick chat during the crisis.
Yes.
I think right in the sort of epicenter of it.
And since then, buy now, pay later has gone nuts. Donald Trump has gone more nuts, and the markets have just gone even more nuts.
Absolutely.
You're here to be the voice of reason on the show, Andrew.
Sure.
But before we do, there's one piece of housekeeping. We're halfway through our Build an ETF competition to build excitement around ETFs for our 3-part series that we're going to be releasing in October. So if you haven't signed up or if you haven't submitted your entries for the competition, think of an idea of an ETF that doesn't exist yet, submit it for your chance to win $1,000. Then go to the Get Started Investing podcast feed and subscribe there, because that's where we're going to announce the winners. And now, Andrew, I'm going to turn it to you. This whole competition is about coming up with an idea for an ETF that doesn't exist yet, but you think should. I'm going to put you on the spot. Do you have an idea for an ETF?
Oh, I certainly do.
Great.
You may remember get my year right, it's February 2018, when the VIX went nuts in the US. And you may remember there were a couple of products one of which was done by Credit Suisse First Boston, and they were what were called inverse VIX ETFs. And what had been happening is people had been basically buying these inverse VIX ETFs, and because of the way the VIX works, the VIX had stayed really, really low, and these inverse VIX ETFs were basically just minting money for people. And you may have heard the phrase picking up sixpences in front of a steamroller, and that's effectively what these people were doing. And what happened is with these inverse VIXs, one day they were quoted at 99 and the next day they were 0, okay, because the VIX went bananas. So my idea for an ETF is the inverse buy now, pay later ETF, which is basically an ETF comprised of short positions in buy now, pay later companies. So basically if these things go down, it will go up. And of course, if they carry on going up, it will fade away to nothing much at all. So there you go. An inverse BNPL. And of course, if you want to get really sexy, because most of these inverse products, they don't just have an inverse product, they have a 3 times gear.
Triple, yeah.
So part B is the triple inverse BNPL.
What would the ticker
ETF.
code be?
The ticker code will be CRASH. Crash.
Nice. There you go. Well, that's a good one. I think we will be touching on the buy now, pay later sector later in this conversation. So let's not front run all of your opinions on the buy now, pay later, but I'm sure people have a general idea of where that conversation's going to go.
Yeah, there's some subtleties about it.
So as Bryce said, we touched base briefly in the midst of the crisis, but a lot has happened since we last really sat down and had a conversation.
Yeah.
So I guess if we start general, what's happened?
Right.
How do you make sense of just everything going on over the last few months?
Sure. It's not that hard to unpack, funnily enough. It may sound really strange, but it's not that hard to unpack. If you go back to February The market's actually topped out on the 19th of February. I'm going to really make reference to the S&P 500 in the US because that's been the key driver of other markets, to be blunt.
Yeah.
So not the Aussie market specifically. But the index really topped out there at about 3,400 or thereabouts. Started to see people just be a little bit wary about what was going on with the virus. And then that really started to gather steam, obviously, as we got into March. And you started to have this extreme volatility in March with, markets moving 7-8% a day. Basically the circuit breakers being invoked in the US virtually every day. And it really culminated on the 23rd of March, which is the real bottom of the market. And the bottom was really created by the Federal Reserve Board saying, we think the market for US Treasuries is illiquid. And you are talking US Treasuries are the most liquid piece of paper on the planet. They are the piece of paper about which virtually every other instrument on the planet, bonds, a credit spread between your bond and the yield on a treasury bond, and equities, it's the ultimate risk-free yield. So you put some kind of pricing mechanism above that into equities, and they were getting illiquid. So that's when the Fed really came in and said, unlimited liquidity. Unlimited. And, we will print money, we will do whatever, it's not the whatever it takes, but it was just unlimited liquidity. That got the market to settle down a bit. And that wasn't surprising. But what was surprising, of course, was what happened after that was once we got into April, May and beyond, which is that the market just took off. And the reason the market took off, with the benefit of hindsight, is the fact that there are a whole bunch of stocks in the US that were really pretty much COVID safe. So the major technology companies, most obviously the Apples, the Googles, the Facebooks, the Microsofts, some were categorically pro-COVID, so Netflix most obviously, and those kind of stocks took off and they've been repriced to the most astonishing degree. That's the astonishing bit. By way of example, if you go back to the end of 2018, Apple shares were trading on about 7.8 times their value of their equity plus their debt. They have net cash, obviously, divided by their earnings before interest, tax, depreciation and amortization, which is a mere $79 billion between you and I. Okay. Now, those earnings are not moving. They're not going up.
Yeah.
Okay. What's happening is basically earnings for Apple for their products are coming down, but the earnings from services obviously are expanding quite rapidly. So you would expect the multiple of that $79 billion to expand a bit. Well, it's expanded a bit. It's gone from about 7.8 to 24.5.
Wow.
Okay. And in essence, that's what's really gone on with the major technology companies, to the extent that the big 5 tech stocks now make up over 21% of the S&P 500 index because they've just so dramatically outperformed. If you want to see that in action, just Google equal weight S&P versus S&P. And you'll see that the equal weight S&P has lagged really dramatically. Equal weight just means that you'd put basically a dollar into each of the 500 companies, as opposed to the capitalization weightings, where Apple obviously, gobbles up the most.
As part of our ETF competition, I've been behind the scenes lobbying to get some equal weighted ETFs into Australia.
Yeah, absolutely. Yeah, they do make a bit of sense for sure. So that's been one of the most fundamental things. And so what you've got is big tech has turned out to be COVID safe, as you reason out. You don't need to be Einstein to work that out. And there's various other sectors, obviously, have just been decimated and have not really bounced to any great degree. So the COVID safe, it's dragged along a few other things, most obviously just bog standard basic consumer products companies. Okay, who they had the same issue in the US we did. So, you have a look at the stock price, something like Clorox, which makes bleach. It's boring as for years. And, all of a sudden, it's up dramatically.
When Trump tells you to inject it in your arm, that's
Exactly. But if you have a look, one of the most obvious things in the US market, for example, the biggest laggard sector is financials, which is banks. So something like JP Morgan, just to give you an idea, they were $135 pre-COVID, let's call it. They got down to about 88. And they're still only 99. So they've bounced, but they've only bounced like 10%. And you can see that with Bank America, they were 35. They got as low as 21. They're still only 24.
Is that because of the low interest rates?
Absolutely right.
Yeah. just for people who aren't too
Yeah.
familiar with banking stocks, maybe if you can do a bit of a basics 101 to explain it.
Yeah, absolutely. The best way to explain it is imagine the price of your cost of goods sold, which in the bank's case is money. Imagine the cost of it is zero. It really can't go below zero for a bank. It has done in Europe, I acknowledge, but let's just take that out of the equation. And as interest rates come down, the amount of money you can charge your customers comes down. So your margin gets squeezed. Okay? So you're not really getting any cheaper money to lend on, and the margin that you can lend it on at is getting squeezed. Your fees are getting squeezed because of competition. And because of the economic environment in the US and everywhere around the world, your propensity to lend is much less. Okay? You can see that in Australia. We can have all the JobKeeper in the world and people sort of sustaining themselves on it. And, you know, whilst the economy is obviously in a bad way, it's kind of, you know, it's sort of off the bottom. But the problem is banks are not going to lend you money if your income is JobKeeper.
Yeah.
And it's exactly the same in the US. So the volume of money these guys can lend out is reduced. And so the banks are making money out of securities trading and particularly bond trading and everything else. And that's not a big, that's not a big multiple business, I'm afraid.
Yeah.
That's the broad reason why.
Just a little off topic, and I know we've got a few things to get through, and Alec wants to touch on Trump.
I'm pretty keen.
Just briefly, given that interest rates are so low, and you mentioned before, Andrew, the using, I guess, your risk-free rate when it comes to treasuries, how are you thinking and valuing stocks now, given that your risk-free rate is essentially squat?
That is a really interesting question, Bryce, because that is the fundamental break, if you will, between someone who would describe themselves as a growth investor and someone who's a value investor. A growth investor now can ostensibly kind of say, well, my stock's worth infinity.
Yeah.
Because my interest rate's zero. And so you've got to compensate for that with a higher equity risk premium. You know, in other words, a bigger risk component that you're using in a discount rate to discount back tomorrow's money to today's value. And that's not being done quite clearly. People have adjusted discount rates down dramatically. That's the heart of the argument, the Tina argument, there is no alternative. That's the heart of that argument. And the other issue is, these very low rates are going to be around for quite some time. Yeah, if they're not, we're going to have a hell of a problem.
Yeah.
If in trying to stoke inflation, central banks are too successful, that will be really painful. It will not be nice. And there are some people starting to sort of place some very kind of out of the money bets on that happening.
On inflation picking up.
On inflation picking up. I'm pretty cynical about it because I think the demand side of things just won't be there once you start taking government support out. But there's a point of view for that. But you've hit on the real issue, Bryce, that if you will, infecting equity markets, people can justify, particularly for companies that are growing, they can justify any old valuation they want. Yeah. And so they don't bother with the valuation because it's too hard. And so what they're doing is they're focusing on the business model. This is a great business. These guys are really good at it, blah, blah, blah. And there's a myriad of examples in Australia, let alone a myriad of examples in the US. The biggest thing that it's doing is it's pushing out the time horizon over which you want to see a profit from the company that you're investing in. So it may have a good product. It's not quite making money at the moment, but you think it will make money and you're quite happy to wait till 2025 for it to make money, as long as the trend is moving in the right direction. And there's a whole sector in the US, the SaaS stocks. There's a proliferation of these things that are cash flow negative, were it not for the fact they pay large slabs of compensation in stock. If you turn that stock-based compensation into cash, they'd be in horrendous trouble. And of course, there's plenty of companies in Australia in the kind of sexy growth areas doing a similar thing.
Now, let me play devil's advocate for a moment. Isn't it good that the market is willing to be patient and let companies develop and make a loss for a little bit of time and, fully mature? Like, isn't it good that investors are becoming more long-term in their thinking?
Yes and no. In terms of yes, just in essence, you've put the pro case for it, be more long-term in your thinking. But the extent to which you have to be long-term at these type of prices for companies is absurd. Because what's happening is that you are going to create, if these companies have access to capital markets with what's ostensibly zero-cost capital, then they're going to become zombie companies. They're going to keep spending on marketing and other things. Yeah, and as we've seen, we'll touch on BNPL, but I obviously don't want to obsess about it and make it the only theme of this broadcast. No, seriously. I mean, there is no moat in BNPL. It's pretty obvious. But that's enabled, every kind of, Bryce Pay and Ren Pay and Andy Pay to, emerge out of a cave. Yeah, and it's because there's basically been free access to capital for basically a bunch of coders that have been able to code up a sort of installment pay app and get some backers for it.
I've got a thesis about buy now, pay later, and I'm interested to have that conversation with you, but we'll leave it till the end because we will obsess about it.
Yep.
I want to come back to Bryce's original question around discount rate and tie that up.
Yeah.
We've spoken about how difficult it is given the risk-free rate of US Treasuries is next to naught. If I can ask a personal question and feel free to answer generally, what are you using for your discount rate at the moment?
Okay, depends what sector I'm in, but I still want, if I'm an equity investor, I'm reckoning I need to get basically somewhere between a 7 to 10% annual return. And depending on the risk in the business, I want much more than that.
Yeah, okay.
Okay. What's remarkable, guys, is that the discount rate, if you will, for SaaS stocks, just as a generalisation, is kind of pretty close to zero. A lot of these companies actually make there is no cash flow to discount.
Yeah,
back.
exactly. Yeah.
Okay, so you can just put a finger in the air. Of course, the alternative is when you start looking at other sectors, and I will touch on two today. Okay, real estate, and in particular retail real estate and oil. The discount rates are enormous. They're gigantic. And so, in fact, the risk premium in those sectors is too big. Far too big, in my opinion. I mean, the thing that we're going to get to in this is that the opportunity for things that are bombed out and underpriced versus things that are just extravagantly overpriced, we're in kind of April 2000. It's as good as it was then. Value investors then had a 7-year run, the like of which they've never seen in their lives before, versus growth investors who were just scrambling around in the dirt.
For people who may not get the April 2000 reference,
tech wreck.
Yeah, you're saying that the market was so top heavy with tech stocks, but at the same time there was a lot of opportunity in unloved sectors.
But surely the underlying conditions now for the stocks that are beaten up is completely different to that of 2000.
Not necessarily. Depends what sectors that you're looking in.
Okay.
Hey, Trump said we'll have a vaccine by November, so
I don't want to mix different cycles because, where we are now, I think has got real mixtures of the tech wreck, which was 99 into early 2000 and the peak in March 2000 when the dot-com bubble burst. And what you had a whole bunch of other stocks. Go back and read Warren Buffett's stuff from that time because everybody said, this bloke's washed up and finished. And then, of course, he performed the house down for the next few years. You could see the same in Australia. I remember, I was at Rothschild at the time. We were buying really good Australian companies on P's of 11.
Jeez, must be nice.
And of course they then, some of these things just doubled inside 6 months.
Yeah.
And then, of course, you have 2008-9, and there are some nice comparisons we can make with one or two things there. Different setup, obviously, but certain value type things got absolutely smashed at that period of time.
Well, you did mention retail and oil.
Yeah,
and I know
absolutely.
there are a couple of stocks in that sector.
Yeah.
So before we jump to Ren's
let's
Trump,
do that because this is an interesting conversation.
Yeah.
Just to give you an idea, in Australia, one of the biggest sectors in Australia, you may say Australia got away with, with next to nothing in the GFC. Okay? Of course, if you were an investor in REITs, real estate investment trusts, in Australia in late 2007, you got absolutely smashed to pieces. And it was irrespective of which sector you were in, whether it was retail, office or industrial. And some obviously bounced quicker than others. And what you found is that because all these trusts had too much debt in them, they had far too much debt. To give you an idea, I went back to some notes I had from March 2009, okay, which was about the bottom of the sector. And the sector in Australia had a market value of $44 billion, and it had debt of 88.
Wow.
Oh, wow.
Okay, so the debt to equity market value is 2 to 1. Okay, and of course they were all out there frantically raising money as quickly as they could. So you look at GPT, for example, which is a big REIT. GPT had to have 2 jumbo rights issues to right the ship, and if you're an investor in 2007, you're still underwater.
Yeah, wow.
Okay, you're underwater 13 plus years later.
Gee.
But one of the things I use to look at is REITs are great because they really stabilise your mind about what the hell investing is all about. And the reason they stabilise your mind is because there is a real asset underneath the REIT. It's an office block or a shopping centre or a tin shed, as I call them, industrial units. And obviously this time around, the things that suffered of office and retail. I am not a bull on office because I think the rents have been too high. And I think that people's way of working is changing. And, I don't believe we're going to work from home forever, but I do believe that we may be only going to visit the office maybe twice a week.
Yeah.
Okay? I think people have caught hold of they like the flex and they like the flexibility. And if that's the case, pretty much everywhere around the world, we got too much office real estate. I mean, one of my biggest investments at the back end of last year was Venado Realty Trust, which is the biggest office property stock in New York. Okay, the stock looked really, really cheap at 70. Okay, had some fantastic developments and everything else. And of course, the world's changed, so the stock's now 33.
Yeah.
And you wouldn't touch it with a barge pole.
New York's a particularly difficult market because they're developing so much new stuff as well.
Yeah, and Venado's the biggest developer of the new stuff as well. So that's changed. One of the things I don't think has changed is shopping centres. Okay, so that
is interesting.
The short term. Yeah, absolutely, of course. They're not in a good spot, but they've reinvented themselves to a degree already in pre-COVID because they've become more entertainment complexes. People actually like going shopping because it's a social activity.
You and I have very different views on shopping.
Yeah.
You don't shop regardless.
No, I am not saying that you are not going to order, a substantial amount more than you did pre-COVID online. I accept that. But there's a certain element about actually going shopping, going visiting, having coffee. Most shopping centres have got a Coles or a Woolies in them, okay, as you know, so they're the key attractions. Some of the centres are going to get decimated because, it is inevitable Myer will go broke. It's probably inevitable that David Jones will downsize, depending on their South African parent. Okay, so that's going to create some problems, but these things are real destinations, okay?
Yeah.
They've got lots of other things in them. Now, what's the thing behind this story? If you look at a property trust, it's got the value of the equity in the property trust, and they've all got some debt, okay? Now, with one exception, they've got a lot less debt than they did last time around. But what's happened, because the share prices of these things have all, not all, but a lot of them have caved in, is there are now 3 large-scale retail property trusts that you can buy which values the property that they own at around a 25 to 30% discount to its book value.
Wow.
Okay. Now, I'm saying, sure, short term, yeah, they've got Solomon Lew, kicking them up the bum, saying, we want to change the rental scheme and everything else. Obviously, some of them, they got shopping centres that are shut. Okay. But they will come back. They will bounce back. They will get tenanted up again. They're still getting about 80% of their rent. It's not too bad. They're paying their way, and with low debt, they're okay. So, for example, to give you, let's put some numbers around it and just give you a bit of an idea. 2 of the biggest ones that are based in Australia are a company called Vicinity. The stock code's VCX. They got a market value of $6.5 billion. They got debt of 3.7. So the total value of the market is ascribing to their assets is $10.2 billion. The value of the assets in the books is $14.3 billion.
Wow.
Okay, that's on about a 5.7% capitalisation rate.
I might just explain, when you've taken the company's market cap and then added in the debt, that's a metric known as enterprise value.
That is a metric known as enterprise value. Imagine, the best way to conceive of it is, imagine I want to take over Ren. Okay, so I pay so much equity for Ren, and I assume Ren's debt on his house. So basically, if Ren has a $1.1 million house and he's got $1 million mortgage, okay, then I might pay him 50 grand for his equity and I get in a bit cheap, because I get his $1.1 million house for $1.05 million.
Yeah.
Okay, so that's what we're looking at here. So what I'm saying is, you can buy 14.3 billion of shopping centres for an effective value of just over 10. And that's about a 30% discount. Hey, guess what? That's where this whole sector was at its worst in March 2009. Centre Group, by the way, similar calculations, 12 billion of equity value, 14 of debt, 26 billion, the properties are worth 34. Wow. Okay, according to the valuer. Now, I should tell you, property trusts ply their valuers with very expensive Japanese whiskey, grand final tickets, and other things we can't talk about on a podcast.
Hey, now, allegedly.
Allegedly, that's right. Okay, so that one's about a 25% discount. The best one, okay, I'll say the best to last, is the big kahuna of the lot. Centre Group, by the way, own Westfield in Australia. Okay, so that's where, so Westfield Bondi Junction is Centre Group. It's not owned by anything called Westfield anymore. Well, is owned by something called Westfield, okay, albeit part of a great big long company name called Unibail Rodamco Westfield. Okay, Unibail's French, Rodamco's Dutch, and Westfield's dinky die. They own 56 billion euros of shopping centres around the world, like US, Poland, France, London. They own the big things that Westfield built in London. Stratford next to the Olympic Village, things like that.
They own the thing that Westfield built at near the 9/11 site.
Absolutely, that's right. Yeah, so they own it's 56 billion euros roughly of book value property. Now, you might think the book value is a nonsense, because the stock market certainly does. These shares are down the best part of 80%.
Wow.
Okay, they're traded in Australia as a what's called a CDI, which is it's basically a depository instrument. So their real trade is in Europe. They've got an equity market value now, down 80%, of only 4.5 billion euros.
Whoa.
They've got 24 billion euros of debt, which they're about to reduce because they're going to have a big equity issue. And so what it means is, if we add 24 to 4 and a bit, we get 28 and a bit billion euros versus the property in the books at about 56 billion. So it's a 45% discount to the book value.
Wow.
I don't mind telling you, I've got to disclose, I have a shareholding in Vicinity.
Yeah.
And I have a much smaller shareholding, because it's pretty obvious, if the market thinks the equity's worth 4 and a bit billion versus debt of 24, it's a bit risky. But I do have a smaller position in Unibail as well.
What's your time horizon on these, though?
12 months, really, that's all.
Okay.
They don't, imagine people start getting back. Let's be blunt. One of the things about Vicinity and why the discount's so big is because they've got 70 centres in Victoria, many of which are shut. I've got to say, if you think Victoria's going to open up and explode positively from an economic standpoint, it's probably the most obvious play you can find.
So let me ask you, why the discount then? Because, they're meaningful discounts.
Absolutely.
And it's not, a discount to an expected future cash flow or something.
No.
It's a discount to the value that a valuer is putting on it.
Absolutely. But you can do your own valuation if you want. You can create your own values for these things. As really big professional REIT portfolio managers do that. They build out DCFs and spreadsheets to do it. So
is the market expecting the value that the properties are valued at to come down
absolutely
in line with that equity?
It's expecting it to come down. And there are 2 or 3 things. First of all, they're expecting obviously distributions or dividends, if you will, from these REITs to be not as good as they were previously. So you've got to price the equity down for that. Secondly, a lot of people are taking your standard view. Online shopping is going to kill offline.
Yeah.
Okay. I mean, we've all seen pictures of malls in the US, but they're more, the US is a different demographic to Australia. There are so few major cities in the US, it's not funny. They're big cities and not big. I mean, the fifth biggest city in the US barely existed in the 1940s and 50s. Phoenix.
Right. There you go.
Why? It's in the middle of the desert.
Yeah.
Okay. And so whereas, in Australia, we've got these two behemoth cities, Sydney and Melbourne. Okay. And the whole point of shopping centres is clustering. You cluster shopping centres to create local monopolies, which is, that was the Westfield model. What do you think Westfield, I mean, so they got Bondi Junction. What's the next biggest shopping centre near to Bondi Junction? East Gardens.
Isn't there one right next door to Bondi?
Yeah, that's not big. That's tiny. That's small. I was going to use another analogy there. I halted my lip. It's a different setup in Australia. But, it is. It's all about people saying offline shopping's dead. We're all just sitting at computers and we don't shop online and there's going to be an ongoing decline and that rents are too high. Okay, that's the third part of it, that rents are too high. Yes, they are. I agree with that. Okay, and Scentre Group have not distinguished themselves in this. Trying to hold people to rental agreements through COVID, without any give and take and no sense of trying to adhere in many cases to the sort of commercial agreements that Scott Morrison put out there, whereas most other tenants have. Scentre Group have been hard. And maybe too hard.
Now, before we move to Trump, which I know Ren wants to, you did mention oil there, and I know you want to talk about Exxon Mobil, but Andrew, you also did say in a text message before that you want to chat about the most infamous 4 numbers in an exchange ticker, 9984.
Yeah.
You will get a shock.
And honestly, we had no idea what that meant, and we didn't look it up because we wanted to be shocked. Well, should we talk about oil first, or should we talk about this?
Yeah, let's just do it oil first. Obviously, ExxonMobil just got booted out of the Dow Jones Industrial Index. You're basically in a situation now because of the machinations in the oil price really over the past 2 or 3 years. Oil stocks have been obviously very poor performers. In many cases, they've been over distributors of dividends. In many cases, they've geared up to buy back stock. And Exxon certainly has been guilty of over distributing on the dividend. But what you're now left with is a situation where Exxon is likely to write down its reserves. One of the key things about an oil company is if the oil price is really low, so if the oil price is $40, and you've got an oil field that's only really profitable at 50, you can't book the reserves because you're never going to drill them.
Yeah.
You're never going to drill them out. Quite clearly, if the oil price, what you notice, you can see this, go look at any oil company annual report. If the oil price is $100 a barrel, all of a sudden their reserves expand dramatically, because the areas that were marginal now become very profitable. So Exxon are likely to write their reserves down by about 20%. They've sort of flagged that but haven't done it yet. But even if you take that into account, at the current market value of Exxon and adding in their debt, their net debt's actually quite small, then you're paying about $8.50 for every barrel of oil in their reserves. That's pretty damn cheap. Okay, for, one of the top, 4 or 5 oil companies in the world. So it's a pretty interesting area to start, looking across. So I own Exxon, but I also own something called IXC, which is the iShares Global Energy ETF.
Yeah.
Okay, and the top 3 holdings in that are, of course, Exxon, Chevron, and Total, the French company. So, oil's a really interesting counter-cyclical play. You've got to remember there's far more oil traded on financial markets than in reality. And that's why oil moves a lot, because you find traders go one way. If you find hedge funds are really short oil, just go long, because they get it wrong time after time after. No, it's one thing they just get wrong time and time again. And, if you can tell me why, in the couple of days leading up to this podcast, oil was down 6% and then up 6% because of Donald Trump, makes no sense. I'm going to keep 9984 for later.
Okay.
Okay. Can I just ask one follow-up question about oil? So You were saying that Exxon's reserves are
Yeah.
priced at about $8.50
Yeah.
a barrel in their share price. And for context, the West Texas Intermediate oil price is around, what, $40 a barrel?
It's
at the
about,
moment?
it's just slightly under 40. Yeah.
So what is leading to that discount?
What's leading to that discount is a few things. First of all, there have been some deliberate divestments of Exxon stock based on basically green trends.
Yep.
So, for example, one of the world's largest investors, the Norwegian Sovereign Wealth Fund, they've basically been divesting various fossil fuel stocks.
Ironic that so much of that fund was built from fossil fuels.
Absolutely, correct. And there are a number of other investors around the world who've taken a view on fossil fuels. And so, Exxon goes, they divest it. Secondly, obviously, at current oil prices, the company is profitable at current oil prices, but don't forget the last quarter they made a loss because the oil price, you might remember the infamous day the oil price hit minus $37.
We remember,
a barrel. Yes. So, they obviously were hit with a weak oil price then, and they did lose money. So their earnings are obviously very, very depressed at the moment as well. But I mean, it's pretty well known. You always buy resource companies not when their product prices are very high. You buy them when the product prices are very low.
Yep.
When they're barely making any money, and then obviously as the product price increases, they are highly levered to. Most resource companies are highly levered to the product price because they have fixed costs of extracting whatever the product is, no matter if it's gold or iron ore or oil or whatever.
So, Andrew, Bryce keeps flagging it every time we move to a conversation that I want to talk about Trump. And obviously, this last week has been a fascinating one because the President of the United States has got COVID, and it appears that an event at the White House was a super spreader event, and a number of White House staffers and politicians have got COVID as well. I guess from a market's point of view, how have markets responded, and how do you expect them to respond to some of the different range of outcomes?
Sure. One of the obvious things to me is that the market obviously fell quite sharply when it became clear that Trump had COVID, and then it's bounced quite sharply. There's some different questioning as to why it's bounced quite sharply, and I certainly tend to probably the minority view. I think that a second Trump presidency would be inexorably bad for stock markets. And the reason why is because he will probably, he won't have an overall majority. There's no way the Republicans will hold, the House and the Senate. But with the second presidency, I think quite bluntly, Trump will go mad. And will, the more extreme components of his makeup will come to the surface. And I think that will be horrendous because just think about what you've had in his first presidency. I mean, you've had horrendous trade disruption between the US and China. Now, I make no comment on the politics of that. There are rationales for it and others that are not. You've had a complete desertion by Trump of his friends in Europe. Okay, so the US coalition in Europe is very weak indeed. And I think that, as I say, I think a second Trump presidency would bring that to extremes, which would have much more impact on stock markets, because the first one basically was driven by a big tax cut, that added sort of $12 plus to S&P 500 earnings as a one-off. So quite frankly, I was a bit surprised that the market was worried that Trump had COVID on Friday and fell to the degree it did. Whereas I think a Biden presidency, notwithstanding he's old and people are frightened, rigid that it becomes a Kamala Harris presidency. So I acknowledge that risk. But Biden's going to be really much more straight down the middle. And so you're actually going to get a return, I think, to much more sensible equity market conditions that do not get driven by, we're kind of negotiating with China. The amount of inside information that's gone on, and the amount of leaks that have driven markets and have driven them to, 2, 3, 4% gains in a day, and you sort of think, what's going on? And it's a Trump tweet or something. So I think we're going to get rid of that. And I think that's generally going to be good for markets. I think there's going to be a lot less unpredictability. Biden's going to be fairly predictable, and I happen to think that's good for business and it's good for earnings. And I think over a period of time, Biden will actually be good for stock markets, much better than Trump. You will have to get over the hurdle of the fact that the likelihood is that the corporate tax rate will go back up. And it wouldn't be surprising, if the Democrats started to put some measures in place to basically equalise the US society by taking away money from multi-zillionaires and redistributing it elsewhere. So that you may think, well, it's bad for markets. It's actually not bad for markets.
Yeah, potentially increases the consumption from a lower middle class.
Absolutely right. So my view certainly is that if COVID is derailing Trump's campaign, which inevitably it is because it's derailing some of the people that are helping him, if it means, and certainly the betting markets are saying that Biden's chances have strengthened dramatically over the last week, I actually think over sort of a 2 to 3 year period, I think it's a good thing. Quite frankly, on a personal note, because of the impact that he has and because of his unpredictability, I don't think I could stand another 4 years of Trump as an investor.
Yeah. Well, they always say that the presidential second term is a little looser because they never have to answer to voters again.
Absolutely right. And this is a guy who's been pretty loose in his first term. So, wow. Yeah, and I just think for American society as well, quite frankly. So.
Just one more question about COVID more generally. Obviously, we're entering a period where, different states in the US have different policies, but also just more generally across the world, we're seeing a real fragmenting in how different countries are responding and their different COVID statuses.
Yep.
And, financial markets and just international trade is so interconnected, but COVID there's just a lot of different responses going on. How do you think about that?
One of the most interesting things is that if you look at what we would typically call emerging markets and Asia, I heard a great comment this morning. If you take the Pacific Rim, which is kind of China, Japan, Malaysia, Singapore, sort of Oz, there's less than 1,000 cases a day.
Wow.
Across that at the current stage, whereas, you've got 7,000 in London. So COVID's a real European issue. Why? Because you've got no boundaries. You can move through Europe with alacrity, and that's the problem. And so you get spreading. And that's been very much the case in the US as well. And so I think what's clear, even though you've had a big increase in COVID cases in Europe and in the US more recently, the death rates are much lower. Yeah. And there's a lot of good reasons for that. Drugs, the treatment, the ability to treat, the knowledge about it. Maybe there's a little bit of immunity, whatever it is. So the death rates are low. And so what's going to happen is these countries are going to really come out and say, forget it, you're going to have to live with it. Because if they shut down again, and they're starting to, that's really bad for the economy. How do you know that? Well, look at Victoria. We reopened and then we shut down again. Okay. And Australia's been, I sort of find it a bit incredible now. We're almost having reporters sort of parked outside, kind of like, there's, we think Ren may have COVID. So, he goes live to our reporter Bryce outside, Ren's temperature's up a little bit. It's down to that level, seriously, which is stupid. And we're now starting to over damage our economy with border closures and everything else. We've got to open it up and accept the fact that it's going to come back, but we know how to treat it now. Back in February, we didn't know enough about it. We know heaps about it now. Yes, we'll eventually get it. We may get a vaccine. Don't forget, vaccines are hard to come by, as we've seen. But I think these countries are going to have to learn to live with it.
We're obviously all speaking in Sydney, and Bryce and I lived near a cluster that broke out, and I was really impressed by how quickly all these resources were pushed into the area. So much testing, they shut some places down, and they contained it. And then a lot of that's eased now. I got ISO'd because I went to Apollo for my birthday.
Oh, there you go. So did somebody with COVID.
Yeah.
So I got ISO'd for 9 days effectively. It was brilliantly done. I got to tell you, it was amazing. I was, I've never been so impressed with bureaucracy in my life. Yeah, really.
I feel like that's the situation where it becomes manageable to open it up. And because I worked with a whole lot of people in Victoria who were pretty down on the whole thing, and it's like there is a way out of it to...
the economic damage at some stage starts to overwhelm, from closure overwhelms the damage of COVID itself, particularly if you isolate nursing homes and things like that and you do sensible stuff. So, certainly, I've been to Canberra recently and, what's COVID?
Yeah.
The place is pretty much open, but it's just changed behaviour. It's about booking in. You've got to book stuff now.
You got to sign
things like
in.
that.
They need a better way to do the sign-in thing as well. That's really annoying every time.
Exactly.
Anyway, they're minor gripes. Buy now, pay later has been teased.
Yes.
And love hearing your thoughts on buy now, pay later. Last time we had you on the show, you were very strong about Afterpay. And I guess...
Well, quote here, the stupidest speculative boom in years.
Yeah, absolutely. It is.
So I'm not even going to ask a question. Just
it's crazy.
Let's start with that quote and see where it goes.
Okay. Let's look at one thing. Buy now, pay later is one component of the fact that the great banking oligopoly of Australia is unravelling. Okay, let's get that absolutely clear. There is a role for buy now, pay later in Australia and elsewhere around the world, to be fair as well. Okay, and it's a simple part of the fact that basically millennials don't have a relationship with a traditional bank by and large. You know, I have 3 kids. They all have accounts with ING, which is not a traditional bank in Australia. It might be in Holland, but it's not here. Okay, and so they have no affinity with a bank. You know, the old days of wearing a collar and tie and introducing little Johnny to the bank manager is well and truly over. And don't forget, BNPL's not the only part of that. Yeah, one of the interesting things is that certainly in very, very recent times, there's been quite big moves in the mortgage broking stocks. So Mortgage Choice, which was absurdly cheap a few weeks ago, so it's bounced hard. Australian Finance Group, AFG, and then even some of the smaller ones. Why? Because basically, 50 to 60% of loans in Australia now are organised through a mortgage broker because there are so many different sources of money. Okay, and then when you think about the fact that big money suppliers, like the KKRs and the Blackstones of the world, are coming into this, and you've got mortgage-backed securities in the market here as well. Yeah, the traditional banks basically are sort of now being left bereft, okay, because you guys don't have a relationship with them. You don't necessarily want one either. And you get your mortgage organised if you want one by a mortgage broker. You're quite happy to take credit from some other source. And BNPL is just another one of those components. The issue with BNPL is it tends to appeal to lower socioeconomic groups by and large, people that can't afford to go any other way. There are some smart other people, and don't forget Afterpay, forever show you, we're not we're not just tendering to people who don't have a lot of money. We've actually got some affluent customers. Yeah, and that's because they arbitrage their credit card. Okay? You can arbitrage your credit card on BNPL very easily. So there is a role for it. Let me get that clear. Let me also get clear, particularly in the case of Afterpay and I think ZipPay as well, these companies are really well run. Okay, there's no question. I mean, the way Afterpay's been built is phenomenal. Their marketing is unbelievable. Okay, it is absolutely fabulous. Okay, but the question is it worth $24 billion at the current stage of development? And the answer, in my opinion, is categorically not. They're starting to cheat a bit as well, which... And when I say
the books or
no. When I say cheat, it's in terms of the marketing and the way that they're trying to get the investment community to look at them. Okay, and that usually raises bells in my mind.
Can you be a bit specific?
I will be very specific.
Okay, great.
Okay, I'll be extremely specific.
I mean, if you don't want to throw allegations, you love throwing bombs.
Most interestingly, on the 19th of August, they gave an update and they said their EBITDA for the year ending June 30, 2020, previous guidance was 20 to 25 million, and they said we've upgraded that to 44 million. And so the stock obviously went up very, very sharply on the back of that, despite the fact it was already capitalised at, the teens of billions, all right? So just think about how much you're valuing the extra 20 million at. But anyway. So then when the report comes out, they make 44 million of sort of company-stated EBITDA, which excludes significant items, which they'd specified. And I got to say, the release on the 19th of August was really carefully worded. It's perfectly legal. They did not say anything in that was in any way misleading. You had to go to the footnotes to make sure you check that out. And then once you find the 44 million, that's sort of reported before significant items, and then the significant items are 30 million of costs in share-based payments, 6.4 million of one-offs, which include such one-offs as international expansion costs. Why are you investing in this company? Because it's expanding internationally. You know, so that's not a one-off cost, and that's a part of doing business. The rental bit, you know, because of the changed accounting, don't forget. So that's not Afterpay's issue. It's just change accounting. So there's $5.3 million of rent not included in that. They capitalised $41 million worth of software expenses that weren't included in that. So by the time we got to statutory EBITDA of $24 million, down from $44, between the two was also a $20 million foreign exchange gain. So $20 million of the $24 million of EBITDA was a foreign exchange gain, and then say no rent, you know, because that's a different part of the game, and capitalised software of $41 million. So on my numbers, they actually made a $41 million loss.
Wow.
Now that's what I call cheating in inverted commas.
Yeah.
Okay.
Yeah.
It's basically every company to a degree does it. You massage the numbers to get the stock market to look at what you want them to look at.
Yeah.
And Afterpay is no different to, you know, the other 2,000 listed companies. It's just that, you know, when you see a big stock price reaction, and then when the result comes out and you look in the detail, you kind of go, ooh.
Hang on a second.
So this company's actually making this company's making what would in any terms be a cash flow loss. Okay. It's valued at $24 billion. Okay. It's got a great position in its domestic market, and now it's going overseas. I believe, you know, categorically that economies are going to struggle. Okay. Because, you know, as government support gradually is weaned off, you know, we know a lot about it in Oz. You know, I believe their bad debts are going to rise. I believe there's significant competition. You know, we've seen that. Remember the PayPal announcement? Yep. So, you know, I just believe that the market capitalizations of these companies are miles too big relative to where they're actually at. Okay. Do I discredit the company? No. Do I discredit their product? No. There is a role for it, but it's a very competitive product. Are Afterpay the best of the bunch? Probably, but they still have that significant regulatory risk that some others don't, you know, because of the credit check issue. And, you know, are they the most overpriced of the bunch? Probably yes in nominal terms, you know, in terms of dollars, but, yeah, there are some other buy now, pay later stocks that, you know, I just think, you know, will do extremely well to avoid bankruptcy, quite frankly. Yeah, Afterpay will, you know, have no issues on that score because, you know, there's enough cult followers to, you know, put $786 million into it after the 30th of June.
So your play is to go short?
I have a small short position in Afterpay. It is a cult company, which is why it's got a $24 billion market valuation, just like Tesla's a cult company. You know, there's no rhyme or reason why the valuations are where they are, but you've got to accept they're cults, and therefore to have a large short position now would be silly. And I do have a small short position in ZipPay as well. I've had short positions in other smaller buy now, pay later companies, and there's one in particular I won't discuss because, you know, I think it's nigh on fraudulent.
Wow.
And you know, basically the stock flies around a fair bit. And it's recently fallen fairly sharply, but now picking up again. And I think there's another bit of scope, you know, to have another short position, which is why I won't discuss it.
Well, a lot to think about for those that are in that
It's
cult.
competition.
Do you want to give the bull case price?
For Afterpay?
As an Afterpay cult member, as a card carrying member?
I mean, to be honest, my only bull case at the moment is just to continue riding the wave of everyone getting into Afterpay. I've sold 50% of my stock, so...
Yeah.
It is, you know. Let's make it clear. This is a real business. There is a real role for it, and they run and they've built it brilliantly. I have absolutely no quibble with, you know, management or anything other than the fact that I think they're starting to sort of tweak the number. You know, they're starting to push their version of the numbers a bit aggressive.
Yeah, I mean, they created a category. Like, I know there was label and stuff before, but there wasn't really. Like, buy now, pay later. They led the charge on. Yeah.
So to close out, Andrew...
Well, we've got 9984.
9984.
Yeah, we've been waiting all day.
Infamous 4 numbers in an exchange ticker.
Absolutely.
We will get a shock.
You'll get a shock. 9984 is the Tokyo Stock Exchange ticker for SoftBank Group Corporation.
Okay.
Okay. Not to be confused with SoftBank Corporation. There are two. Okay, SoftBank Corporation is controlled by SoftBank Group Corporation. So, SoftBank Group is obviously the top company in the pyramid. It's the one that Masayoshi Son owns 27% of. It's the one that's got the Vision Fund that had the WeWork in and everything else. It's the one that aggressively bought call options over a whole bunch of US technology stocks in August and seemingly made an awful lot of money out of it. We won't go into the machinations of that because we'll be here all night. Despite my questioning of tech valuations, and I have a number of small shorts in SaaS companies in the US, I have about 10 separate short positions. All
Salesforce, one of them?
No, it's not.
Good.
Examples are things like Splunk, DocuSign.
Okay, yeah.
I have a very small short in Zoom, which is about valuation. The valuation's crazy. The product's really good.
Yeah.
But the valuation's bonkers. So there's a few others. But one of my counteractions to that is, in fact, I have a long position in SoftBank.
Right.
Okay.
Which sounds absurd because obviously, Masayoshi Son, has sort of acted like a bit of a maniac for a long period of time. But the degree to which SoftBank basically are trying to de-gear and de-lever their balance sheet is phenomenal. The asset sales they've made are phenomenal. They've made them at good prices. And the thing that tipped me over the edge to go was the fact that they're selling ARM, which is a UK-based chip manufacturer, to NVIDIA for $40 billion US, which is not a big return on what they paid for it. Roundabout, basically 3/4 of that holding rests in SoftBank, the other quarter's in the Vision Fund. And it helps to keep de-gearing SoftBank. My estimate of SoftBank's net asset value is around about 14,000 yen plus, and the current stock price is 6,900. And it got as low as 2,800, I've got to tell you. And you've got around about 10,500 yen a share of SoftBank is their stock holding in Alibaba. So if you're a bear on Alibaba, don't go near this. But it's a really interesting hedge for me to some of the other things that I'm short. And, the way they're de-gearing, and also they've alluded to the fact that they might look to go private. And there's some rationale behind going private. So Masayoshi Son can get off the pills and can go as wild as he wants.
Isn't that a risk though? If they go private and the share price is around 7,000 yen, even if the net asset value is at that 14,000 number,
you may not get the whole NAV.
Yeah.
They've had Elliott Management on their register, who did help play a role.
Big activist,
big activist fund. They're the guys that got on BHP. They're the guys who tried to unwind Hyundai and things like that. So it's been really interesting. Basically, he's obviously going to settle down. He's sold assets for a little while. Look, he'll go through another wave of things that make you uncomfortable, but maybe that'll be when he's private. So. Why do I bring that up? Two reasons. One is just so you don't think I'm a bear on everything technology. But secondly, I think it just underpins, perhaps a lot of what we've been talking about tonight, which is we've been talking about how do you buy assets really cheaply in a world where many, many assets are fundamentally overvalued. Are there any cheap assets left with stock markets where there are? Absolutely there are. So sure, Melbourne shopping centres that are currently closed may not be your cup of tea. Big oil may not be your cup of tea for a variety of other things, but maybe a mad Japanese entrepreneur in the tech space might at half asset backing.
Sounds like that's up my alley.
He has debt, okay, and it's a really complex company. So if you want to go analyse it yourself, take a week off work.
So just to recap on those numbers, so you said that the stock price was 7,000 yen
it's
or
about
thereabouts.
6,900 yen at the moment.
The net asset value was 14,000 yen.
In my estimation, okay, and that other people will give you different numbers.
But of that 14,000 yen, around 10,000 yen was just in stock of Alibaba.
That is correct.
Geez, that's a pretty concentrated bet.
So it's
Well, you've got to remember he was
Long
the first.
Alibaba.
He was one of the first external investors in Alibaba, and he just let it grow. He sold some along the way.
Does
but not
that
much.
because SoftBank is a Japanese telco at the end of the day? Isn't
Correct,
It?
Nat. Yeah.
So does that net asset value include their whole telco business?
Yeah.
as well?
What it does is basically what I've done is I've deconsolidated SoftBank Group Corporation's balance sheet, and obviously they are the largest shareholder in SoftBank Corporation, which is the telecom company. Okay. They also have a major shareholding in what's called Z Holdings, previously called Yahoo Japan, and there's a bit of telco in there as well. And then of course they've got another telco, which is they recently merged Sprint, which they were the majority owner of, with T-Mobile in the US, and they've got a bunch of T-Mobile stock, which basically they're getting out of through some quite complex derivative transactions. There's nothing easy in this company.
No, this sounds like a highly complex company.
It is. This is MBA material.
Yeah.
So, they're the main things. And then they own basically a chunk of the Vision Fund, but they have obligations to the other investors in Vision Fund, which are the Saudis in particular, and they have to pay them a preferred return. Okay, so they are leveraged to the returns of the Vision Fund, which is why the stock went down so badly, because, of course, they were leveraged to the returns of WeWork, which are negative.
Well, it wasn't just WeWork. I mean, WeWork was the big one, but they threw a lot of money at a lot of companies. Their thesis was,
Go for it.
You give one company in the sector so much more capital, they'll kill everyone else.
Yeah.
Basically, what they were doing is it's kind of like, hey, Ren, I'll get you going. I'll buy 10% of Ren for $10.
Yeah.
Okay. And then we say, right, we'll buy the next 10% of Ren for $20,000. And
We need to talk to them.
Yeah. And that's really, I mean, in essence, that's what they were doing.
Yeah.
Okay. I mean, I don't mind telling you, there is some unadulterated crap in my view in the Vision Fund.
Yeah.
Okay, at crazy valuations, okay, and stuff that won't make money, or stuff that when it comes to public markets, they have to take a write down on. So, I mean, obviously, Uber was, one that came to public markets. They obviously have a big stake in Didi as well. So, I mean, they've sort of covered off every rideshare thing that you can cover off. I wish they'd cover off on A to B, otherwise known as cab charge, because it's way cheaper than any of them.
Still on cab charge.
It's a payments company now, Bryce, don't you know?
My favorite SoftBank Vision Fund investment, and we're not just trying to beat up on this investment, but I love this story. They invested $300 million in a dog walking startup
correct.
called WAG.
Absolutely
You're
right.
kidding.
Have a guess if they made money or lost money on that investment.
Let me guess.
They've already realised.
Yeah, they've written it down.
Oh my God.
Yeah, there's some, if you said to me kind of like, this guy's a bit out there, surely, and justify this and justify that, the answer is I couldn't. What I'm looking at now is in an environment where he's divesting assets at not too bad a prices. I mean, you can't justify the price he paid for ARM in the UK. No way. It was nuts. When I was running my spreadsheet on SoftBank a year ago, I had ARM written down dramatically from what they're now going to sell it to NVIDIA for. So that's why, in each of these things there's a catalyst. And I should say the stock's gone up pretty sharply over the last few months.
At the end of the day, and like all jokes aside about the Vision Fund's bad investment, like the thesis that you have there that you're buying, 14,000 yen for 6,900 yen, like that is classic value investing.
Yeah, absolutely.
Yeah.
Which is why you've seen value investors in it, which sounds crazy. And it's all about, can you justify the 14,000 yen? That's where your homework comes in.
Yeah.
I mean, it's actually getting to, in SoftBank, it's actually getting to understand what they actually own to start with. But there you go. But, hopefully that gives you, a few clues that there are a lot of value things out there. You can buy a lot of stuff that's pretty cheap. In Australia, obviously, our index is probably being held back by the fact that, a quarter of it's in banks and, they've still probably got a rough patch to go through, bad debts and cramped margins and everything else.
Well, if we really are in April 2000, we may see a decade of value outperforming growth. And if that's the case, we look forward to continually getting you back on the show to hear you crowing about it all.
I never crow, because once you start crowing, there's a car accident round the corner. So it's very humbling, investment markets. Just when you think you've got them nailed, they nail you. So there you go.
Well, Andrew, you always leave us with a lot to think about. So thank you again for
Absolutely.
giving your time to come on the show.
Not a problem.
We look forward to, what are we, October now. So we'll be coming up on our bold predictions recap episode
Absolutely.
reasonably soon.
I have come in, I think, from one of the bold predictions last time. I think we did chat quite extensively about Baby Bunting last time, and
Yes.
I am coming in on the day that Baby Bunting had their annual general meeting and put forward some pretty good new sales numbers. They've been very conservative, won't give forecasts for the year, which is understandable. But I think the stock got as low as 180, and it's now it's not far off $5. So,
Wow.
and it is. It's a phenomenal business that any kind of part-time MBA student should be able to work out as a phenomenal business.
Yeah.
So there you go.
Well, we can touch on that in a couple of months. But again, thank you as always.
Pleasure.
Good to have you on.
Absolutely. I've thoroughly enjoyed it as usual. And so happy hunting out there, guys. Thank you.
Thanks, Andrew.
Thanks, Andrew.
Thanks for listening to Equity Mates Investing Podcast, a production of Equity Mates Media. Please remember that everything you hear in Equity Mates Investing Podcast is general advice only. The content has been prepared without knowing your personal objectives, specific financial circumstances, or goals. The host of Equity Mates Investing Podcast may maintain positions in the companies discussed. Before considering any investment, please read the product disclosure statement and consider speaking to a licensed financial professional.